Good afternoon, everyone. Welcome to the Tricio webinar. Today, we're going to talk about structured products, whether we got better terms now as rate rise. So we are going to talk about this topic. One of the things what we're going to say to you is that if you can actually type any questions in the chat box or the Q&A box as you go along. If you can encounter any technical question, you should type in the chat box. Otherwise, you should type any Q&A about the webinar on the Q&A box. We're going to start now. Okay. A while ago, I've been talking to some clients. He basically said that there are three people who are affecting markets a lot recently. And obviously, one of them is gone. And in fact, his esteemed partner has just gone as well. So instead of three amigos, we have two amigos now. And they are actually causing a lot of problem for a lot of investors because they have to fight inflation and keep hiking rates. In this difficult environment, many people ask us, should we continue to use structured products? Because structured products terms should have improved with the better rates now. And also structured products have always been considered as a good alternative in a client portfolio. So we're going to visit this question, this topic today in this webinar. What we're going to do is to talk about the rising rates and bond yields. My colleague John Coverley, Chief Economist of Tricio, will be talking about the macroeconomic fundamentals behind this market behavior. Then Jerry Salaya, our Chief Strategist, is going to review what's happening to bond yields and stock markets. Then I will go through the rest of the webinar talking about how rates, if they rise, affect terms of structured products, learning from lessons from the past, and also how structured products can be used in the current environment, with some examples as well. So what I'll now pass on to John.
Thanks, James. I'm going to be very brief, just this one slide. I just wanted to emphasize how the economic environment right now is so different to what we saw in the 2010s. It's a little bit like 2007 in that interest rates are going up and stock markets are struggling, but inflation is, of course, is much higher. So perhaps it's more like the 1980s or even the 1970s. But where we are now, we've got full employment, and really full employment, and that is driving wages. We've got obviously very high inflation, some of which is transitory. The energy and food prices, they may or may not come down, but they certainly shouldn't keep rising. But still getting back to 2% inflation is going to be tough with where we are with wages now. So obviously we've got rising policy rates. We've got very hawkish central banks. We and the markets are anticipating a mild recession, but only a mild recession. And what I think that means for rates is they go higher in the near term, policy rates. Then they probably pause for an extended period, and then they fall back. But they're probably unlikely to go back to zero. In the 2010s, after the global financial crisis, rates went right back near zero and stayed there pretty much for 10, 12 years. This time, I think they will come back, but we're probably thinking of a range of 3 to 4%, something like that, for where rates go, rather than all the way back to zero. That's our central scenario. The risk scenario, I think, is that we get a much more severe recession for some reason, and rates do go back to zero, and we're back in the 2010s environment. In my view, that's unlikely, but that's certainly a possibility. Over to you, Jerry.
Thank you, John. James, if you could move to the next slide. Thank you. I'll be going through 4 slides here, looking at yields in the US, UK, and then the US S&P 500 and the FTSE 100. Now, going on what John has said, we can see that short rates have gone higher, and that's translated into higher yields in the 5-year T-note and the 10-year T-note as well. You see higher yields, quite sharply higher yields over the course of this year. The key question for bond investors is, are yields going to continue to go higher, or are they going to fall sharply or just plateau and basically trade in a range for a while? We're leaning towards the latter, on the view that currently yields about 4%, 4.2, may be closer to a peak than anything else. So we're not looking for yields to push much above 4.5. We might see 5% in some of them and on spikes, but we're not really looking for 6% yields on the 5 or 10s. And in fact, we're kind of looking for 4.5 to more or less kind of potentially be the peak of these moves, which means for bond investors, what do we do now? And our view is that basically we're going to trade in a range somewhere with maybe 3.5 in the 10-year, maybe 3% at most, and then 4.5, 5% on top. And that could define our trading range for maybe a year, 2 years, maybe even longer, if John is right about central banks not pivoting to lowering rates anytime soon. And if things pan out on the economic side, so we do have a mild recession rather than any sharp swings in sentiment. Next chart, please. The UK is in a similar scenario, except of course, the events of the last few weeks have exacerbated the yield upside. We've seen some very big spikes in the 5-year, 10-year, even on 30-year gilt, and as well as inflation linked. Anything that pension funds had to sell, they did sell, it seems. So we're looking for stability, which given the current state of affairs is a hard word to contemplate when thinking about the UK, but we're looking for stability, and hopefully that'll translate into the gilt market. And we think here as well, we've probably seen, or we are closer to the peak in yields than anything else. And so we'd be looking for some sort of trading range, again, below 5% for the most part, and maybe down to 3.5, 3% on the downside for the next 12 months, maybe even 18 months. And thank you, James. You anticipated me. The S&P 500, please. Thank you. And here we've seen what's happened in the stock market, where you have a 22% fall year to date so far. And again, we can see some downside risk if we start losing the 3,300 area, 3,000 area. That's another, 5, 6, 7, 8%, 10% maybe. And then I don't think we're going to see much more below that if things work out. So I'm not looking for a return to the 2020 lows. But obviously there is downside risk in the near term, that's for sure, and the medium term even. But if the Fed does actually reach a level of Fed funds where they can hold steady for a while, sometime next year, and if bond yields do consolidate, then we would expect the equity market to consolidate as well for some time. So it could be a period of choppy range trading above 3,000, let's say. Next slide, please. Now, the FTSE 100 had been holding up really, really well this year until recently, and it's only down around 6% year to date. There is some risk that we see the international companies that make up this index, or the heavyweights anyway, come under pressure, and that could give us another, let's say, 5, even 10% downside over the next few months or quarters. However, looking out, again, here too, we would expect a broad range of consolidation over the next few years, rather than a huge move down to test the 2020 lows. So that's it for us. Basically, interest rates are up. They may not rise much more. And equity markets, they have some downside risk, but we would expect a range trading scenario to happen after that. Over to you, James.
Thank you. So as you hear the backdrop of the investment and market, we have a slowing economy, high inflation, rates stay high, stock market may be going nowhere. This usually is a good time to consider structured products, because a lot of the times on these in the past, equities and bonds do not perform real well, and investors looking for alternatives. Now, what are structured products? Because many people think it's a complex instrument. I actually look at it relatively simply by just two things. First, structured products is a buy and hold investment, supposed to buy and hold it, and then you get a defined payout of capital at maturity and a defined return. This is important. In other words, the investment performs not just because of market or at all by the fund manager. It actually is formula driven. So you know that from the outset, if the market do X, you get Y from your investment. That is one feature of the structured product. The other feature is that these payout, the capital payment, repayment, and the returns typically are linked to the performance of some underlying assets. Typically in the UK and also some offshore private investors use a lot of stock market indices, S&P 500, FTSE 100, Euro Stoxx 50. In Asia, Hang Seng, or topics. Some people use stocks, some people use commodities, some people use also currency and interest rates. So these are the underlying assets. Their performance can actually affect the capital and or the return. So what it is a structured product is issued by typically by a bank, and then it is actually a form of a security like a bond. It's basically the bank issues some money, you lend money to the bank and issue this debt security. It could be a deposit. Similarly, you lend money to the bank and then you basically get a return on deposit. Usually for deposit, your capital is protected, and in many countries, including UK, retail investor gets deposit insurance as well. And in the very beginning, when structured products were first being done, sometimes it's launched as a closed-ended fund. So you get fixed number of shares and it doesn't change over the life because of buy and hold investment. And as I said, you have defined capital repayment and defined return. They could be fixed. If it is capital repayment is fixed, that means you got your minimum capital, typically 100%, sometimes a bit lower, but we call it capital protected product. Sometimes the return may be fixed as well, but more likely is linked to the performance. It could be, as I said, the index do certain things, you get that return. So there's some examples here further in this table here. Let's look at some combinations there. In the first column is capital repayment, and then second column are returns, and third column is whether it's paid regularly or maturity and what type of product it is. The first row actually technically is not a structured product, although it's a starting point. The capital repayment is fixed and maturity, typically 100%. Returns are fixed, are paid regularly or a maturity is technically a bond issued by the product issuer. Now, this is a starting point, you get a bond, but what you could now do is actually playing around a little bit on different combinations. You can have the capital repayment and maturity is fixed, but the returns variable. It depends on the market performance and sometimes the amount depends on it. You could be paid regularly or maturity. This is a capital protected product. We'll see some examples later. For example, there'll be capital protected product over 3 or 5 years. At the end of the product, you get your money back. If the index is up, then you get a fixed return. That is a capital protected product. Now, what you get is that potential return should be higher than what you get from the fixed income bond. You actually take a risk on that return because it may be zero. In exchange of getting that risk, the return should be higher than what you get from the bond. Now you can swap it around. You can have the capital repayment depends on the market. You start to take risk on what you get at maturity, and the return are fixed. And typically this return pays regularly, and the technical jargon for these are called reverse convertibles. Sometimes in the private wealth world, it's called high income product. For example, it may pay in the current environment 7-8%, which is higher than the 4 to 5% bond yield. And what you get is that you have the repayment of capital. Maturity depends on the performance of the market. Usually there's some kind of what we call soft protection. So if the index or the underlying asset does not fall by more than, let's say, 40%, you get your money back. Otherwise, you lose money. So start taking a view. Over the next 4 or 5 years, the investment return of the product, I don't think the index will fall by that amount dictated by the soft protection. By taking that view, I get a higher income. With the risk that actually my view is wrong, I start losing money. So that is the other combination. The last combination is that actually you have both the returns and capital repayments linked to markets. And obviously you take even more risk that way and you get enhanced return. A typical one that we see nowadays, very popular in the private wealth and retail market, are auto calls or kick-out plans. You every year or every 6 months, you look at the market and the index. If it is at about a certain level, you get a return and you got your money back early. Otherwise, you keep rolling and rolling and rolling. Your return, if you get later in the years, will roll up and get larger and larger. And the risk is that actually the market keep falling, you get no return, and it breaches that soft protection barrier. You lose money. So we start with bond, your certainty of income and certainty of capital repayment. You start taking some risk on the return, then you get potentially higher return, but at least your capital is safe. Or I could swap it and I say, I want fixed return, but I am taking some capital risk. Either one, you get a higher return that way. But then you basically say, I want to relax that even more and link the return and capital to market performance, then you get an enhanced return. So this is the backdrop. The reason why I mentioned this evolution or how product it grow from one to another is that it actually gives you an idea what affects the terms and the price of structured products. Remember, the most basic form of structured product is just a bond. So it will depend on interest rate, short-term and long-term interest rate, and the shape of the yield curve. And also because the structured product is issued by an issuer, it depends on the credit quality. An unknown bank with no rating, you probably take more risk that is not going to pay you the money and the return. You should be compensated by taking that risk with better return compared to a safer, more reputable financial institution. Then other factors here, these are, we won't be able to cover this in this webinar, but there are other technical trading factors in the underlying asset markets, typically on the options market: volatility, dividend yield, correlation between different indices or stock, which is important for what we call worst of payoffs. And these are the things that affect the structured products terms. As you see, rates, credit, and the market of the underlying asset. So the question is, if interest rate rise, how would that affect the terms of the structured product? And also, importantly, which of these will be better for products? A steep yield curve, flat yield curve, or an inverted yield curve? Now, to answer this question, what I've done is actually look at what happened in the UK specifically over the last 15 years or so. Now, here's the yield curve. Okay, it's actually plotted a long time. Okay, over from 1996 to now. And although I said a difference over 22 months, I'll tell you why later, why 22 months. At the end of 1996, which is the top line in purple, you could see that actually interest rate for 2-year, 3-year, 4-year, 5-year, 6-year, 7-year, all these long dated interest rates are quite high. Those are years when rates were above 7%. Most of the investors in the UK investing in income or annuity, they get about 8% return. Then those were the days, and then it started dropping. And then it dropped to the silver line in 2000. Partly that was because of in UK, because Bank of England has become independent, and that actually helped to make the rates lower. And also importantly, markets start to be more volatile. Remember, that was when the internet stocks boom starts. So rates start dropping because there were concerns that actually stock market is going to drop. Some people buy bonds, so you can see actually get lower. Then it keep dropping until the red line, which is 2008. That is when the global financial crisis hit. And at that point, yield was about 6-year rate is about 3%. And you go down further, the line at the bottom, which is nearly touching the zero line, is end of 2020. That is when the pandemic, COVID, is hitting around the world. Everyone is actually pursuing quantitative easing. Rates go down. Look at 6-year rates. It's literally zero. You have no interest at all you could use to buy returns on structured products. And we'll see what people do at those years. Now, one line that I haven't actually mentioned is the dark line in the middle. That's actually now, sorry. You can see that actually it's jumped a lot from nearly 0 to over 5%. And that is actually what happened now. You can see over 22 months, a lot has happened. So in theory, now interest rate has gone better, then hopefully that will improve product terms. And we can look at this evolution of swap in or interest rate in the UK with structured products development. 1996, that was when the first capital protected closed-ended funds on FTSE 100 is actually sold in the UK. 5 years, 100% capital protected, pays at maturity 133% rise of FTSE 100 uncapped. So the index is up 10%, you got 13.3%. Of course you can do that because at that stage, look at the interest rate is above 7%. And in those years, volatility of the index options are relatively low. But things start changing. In 1999 and towards 2000, interest rates keep dropping. And investors, remember, get used to 8%. They want high income product. So product providers start looking at these reverse convertible. They introduce capital at risk product. And they say, look, the FTSE 100 has not dropped over the last 5 years or 6 years. So you could take risk on that. And you got 8% return. And maturity, if the index hasn't dropped, you got your money back. Otherwise, you got 1-to-1 downside. So every 1% fall on the index, lose 1%. That's that. And later on, we introduce some soft protection. So give some extra safety. So you allow some downside to happen between now and maturity, and you still get your money back. But that produced a high income product. And that was quite popular in those years. Now, interest rate keep falling, as you see, actually, a silver line, and it keeps dropping towards the orange line, and it keeps dropping lower and lower. The problem becomes for product provider is that the interest rates start to become to 3%. It's difficult to create capital protected product. And volatility in indices remain high, so it's quite expensive to get upside or return on the index. So they start reintroducing auto call or kick out structures. What it does is these structures is supposed to have a 6-year life, but if the market performs well, you get actually your money back early plus a return. So what this product benefit is longer term funding because interest rate will be 4 or 5 years, but you got potential return that is paid in year 2, year 3. That means that that potential return is lower. So you start optimizing these things, and this is one of the first auto call structures. And then they add capital at risk feature on top, and this is now one of the most popular structured products in the private wealth around the world, not just UK. And then as the rates continue to fall, you actually got more and more ways to try to improve the return. And one of the things that they start to do is worse off. Worse off means that you pair up underlying indices, and actually the performance of the structure in terms of returns and capital replacement is linked to the worst performing index. It could be 2 indices, 3 indices, 4 indices, 3 stocks. Some people do gold with FTSE 100, oil price with FTSE 100 and things like that. So they had to start pairing this up. And this also enhance return. Why? Because now you need 2 or 3 underlying to perform in line with each other and positively to get positive outcome. So headline rate improves, help your marketing and promotion, but start to actually make it a bit more difficult to understand and see how the product could perform well in different environments. 2008, global financial crisis. We have Lehman Brothers and also RBS in the UK being nationalized. Regulatory review follow, and because of this, and see what structured products have been doing. Before that, between 2002 and 2008 is probably one of the golden eras in retail structured products in the UK. You have a lot of independent providers and banks working with each other to launch products. You got some very innovative payout. Some actually, however, are affected by the global financial crisis. Obviously, some of them may get, they were linked to Lehman Brothers, then obviously there's a bankruptcy involved. Some because market performance doesn't get the return. So after that, the UK regulator review how product development is done for structured products. And after that, in 2013 and so, products become simpler and simpler. And you can see similar type of product now we see all in the UK retail offering. And the same actually applies to Europe as well. And in the offshore space, they have very similar products compared to 2002 and 2008. Now, as you can see, interest rates keep falling and falling. The other trick has been doing is long dated product. Now, as I said, the earliest product is about 6 years. Now you get 10-year product in 2010. Now, the argument is that for such a long dated product is more likely to have a positive performance. There's no difference for actually most people arguing and advising clients that you should hold on to investment for the long term. So that is one thing, but sometimes remember that these products are supposed to be buy and hold. And if the product is not auto call early, you need to hold the product for 10 years. 10 years is a long time. And history and human behavior tell us that we are very poor in pricing long-term risks in terms of predicting what's going to happen, predicting the uncertainty. So that's one thing that I think some advisors actually were not really considering such a long-dated product. Some advisors are comfortable, depending on the conversation with the end client. And after 2018, as you can see, the rate were even lower. And then you also have market, some dislocation in markets on dividends, correlation, etc. We start to see more esoteric indices like dividend discount index, or even applying to stocks. When you use a stock, you actually discount the stock with a fixed dividend yield rather than the actual dividend yield. I won't have time to talk about this. We wrote some blogs before on this. At the end of the presentation, you can find a reference on those blogs, and you can get a little bit more understanding about the technicalities of these indices and techniques. So what have you learned from the history? Structured product terms and price are not just affected by rates. Always you see market volatility is important because market volatility affects how expensive it is to buy upside return. And volatility high doesn't mean that actually a rate high is going to give you good returns, because volatility is too high. It's very expensive to buy returns. Both long and short-term rates are important. Well, the reason why auto call works is because in a flat yield curve or inverted yield curve environment, sometimes you actually have potential early maturity, means that you don't actually have to have a 6-year yield, but maybe actually having a 3 or 4-year yield to price a product. And that works because that yield is higher than 6-year yield. And remember that headline terms is not equal to actual outcome. It still need to be driven by market and payoff strategies. Sometimes it's right to ask, is too good to be true, and ask why we have that headline rate and what's the likelihood of getting those returns. And obviously the potential return depends on the risks being taken both on capital and certainty of returns. Remember the table that I show. If you have higher certainty in capital or returns, that actually headline rate is going to be poorer and the potential return may not be very high. You take the risk, then you potentially get better return. But remember, that also means you may get no return. And obviously, funding needs of the product issue important, and credit risk, that's what we have experienced during the global financial crisis. Nowadays, less so. Even the recent days, they will talk about Credit Suisse again, and these type of issue may come back, and a lot of advisors asking questions again, whether these product issuers can sustain. The overall thinking is that after the global financial crisis, regulators and central banks require the banks to really recapitalize. And with that, actually, that risk is probably a bit lower than what we saw during the global financial crisis. And some technical points here, long-dated structured products are like bonds with long duration. So actually, it's more sensitive to bond yield movement. 10-year product, if you look at the mark-to-market price in the secondary market, will be more sensitive to the long bond yield movement because it's a longer duration. The implied probability of whether strategy will produce returns will affect the product price and terms. So remember, I said worst of strategies require performance of 2 or 3 more underlying to be in line with each other. The probability of that actually generating return will determine whether the headline rate is higher. A very high headline rate doesn't mean that you actually will get that return. You will probably have a lower probability of getting that return, and therefore you need to be more certain that your view will be true and will turn out to be as expected. And capital at risk product, in the same way, the market implied probability of whether a product will return full capital maturity affects the product terms. I mentioned soft barrier, a protection barrier of 40% below starting level. Usually, it's about 35 to 40% nowadays. But in the past, there are people who usually only 20% below. 20% fall over the next 4 or 5 years is more likely than falling 40 or 35%. Therefore, the risk of capital for a barrier that is only 20% below starting level, that risk is higher, and you expect to actually get better return. And obviously, we talk about kick-out dates. Sometimes delaying the kick-out days will improve terms. Sometimes actually making it early, especially with inverted yield curve, may actually improve terms. Now, what we see in terms of this, our view, with rising rates now, remember the black curve, we're now actually inverted in terms of in the UK, the inverted yield curve, also in the US as well. And they're close to what we got about at the turn of the century in 2000. What we think or the possible impact of the rising rates. We think some of the maturity of products become shorter. It's already starting to be evidence in what's being offered in the open market. More capital protected products or better soft protection barrier level, more fixed or high return products. We have first auto or kick out date. In the past 2 years, it may be delayed to year 3, year 4. Maybe it's going to move back to year 1 or year 2. And possibly now with high interest rate, we don't need to rely on those more complex indices. Maybe go back to mainstream indices. Now, this is evidence, hopefully with better headline rates and hopefully back to better actual outcome to investors as well. Now, I've just done a survey. We've done very quickly of different product providers on different kick-out plans. First observation is that FTSE 100 is returning, and obviously the rates are quite good, 9% per annum. Okay, this is per annum. And then you have other things like the barrier is 60 to 65% of starting level. That allows the index to drop 35 to 40%. About 5 or 6 years ago, to get these rates, you need actually 2 indices and maybe going to 7 to 8 years. And notice that actually most of these are now actually 7 years or shorter. We also see capital protected deposit coming back, and you have these like, I'll emphasize like the fourth one here, a 6-year deposit, FSCS protected in the UK, sterling base, and if the index is at above the initial level at end of 6 years, you got your money back plus a 50% return. That's good. So in a flat market, if we continue six years, the index may give you no return. This structured deposit can potentially give you 50%. If the market is down, you still get your money back. This is a type of product now we see, and this is coming back in the form of deposit and other capital protected structures there because rates have risen. Now you argue that, look, James, these are all different. Look at the terms, they are very different, and they seems to be depending on the bank. That's true, but it also depends on time and also offer period. And that's one of the thing about open offer. When the product provider lock in terms and the offer period affects the terms, sometimes locking it earlier or later may make the terms better or worse. So one of the things we have been often talking to customers about is customized bespoke structured products. So we design bespoke structured products and basically possibly try to get better terms and open offers. We could then set the initial reference level at the time that you as wealth manager or advisor think is right for your clients. And it may also better meet your investors' views. And you can use other banks and issuers than in the open market and use strategies and underlying assets that fit your portfolio needs and your market views. Remember, I said you could use commodities, you can use stocks, you can use interest rate or currencies as an underlying. So this is what we did. We did some bespoke pricing, and this is somewhat we got there. Just an example of then 6 years sterling base, FTSE kick out. You could see actually on a bespoke base, it's possible to get a deeper protection level, 40% below starting level, kick out starting at year 1, and you get double-digit headline rate, 11% per annum. So that's one possibility. And you could even have actually defensive level. That means the kick out is not 100% of initial level, but 10% below starting level. You still got 8.5%. That was not possible 5 or 6 years ago. You may not see an open offer, but if you do bespoke and customization, that's something that you could do. And the other customization is to use different currency indices. You may have a client that actually sterling based, but interested to do S&P 500 instead of FTSE 100 as a kick out. You can see a 5-year kick out plan, 90% of starting level as a kick out level, 40% for of the index, still above 9% per annum. And then, or you got a dollar-based investor who want to do a FTSE kick out, as you can see, you could do that as well. Headline rates 8.5%. And so forth. You could do a deal index on Euro stocks with the S&P 500. For Euro investor, you could get above 10%. And the kick out level is still 5% below the starting level. And notice that it's semi-annual kick out. You could actually not have kick out every year, but every 6 months, starting from end of year 2. So this, again, customization exercises. We haven't seen a lot of income products, so I priced a few ones up, and you can see here something as simple, 5 years in sterling base, linked to FTSE 100, quarterly income, 7.2% per annum headline rate, barrier or soft protection, 40% below starting level, and different combination there. Look at 3 years, the second row. I said the yield curve was inverted. 3 years, similar protection level, same index, 7% per annum. You don't lose a lot of the headline rate that way. So these are just some examples there. We'll show you, we'll send the slides to you afterwards. The indicative example pricing, but then you feel that actually we could customize things. And as I said, you could use stocks, commodity, FX, interest rate. And we have different resources on structured products. Here are some blogs. We have podcasts, and also our blogs also talk about market fundamentals. Remember what we say: sideways market, high rates, auto calls, return that have a digital payout. In other words, market do nothing, you got a high payout, or high income products are quite interesting for the time being. If you're interested to listen more about this, please let me know. We'll organize follow-up section, probably also to look at bespoke pricings in a webinar environment as well next time. With that note, I'm going to end the presentation here. Thank you very much.